traders from across the globe, and welcome to Short-Term Trading Live with Oscar 776 video, baby. Yeah. My name is Oscar Corboni, and I come right out of the pits on Wall Street, where I have learned tons and tons of tips, tricks, and techniques that help me stay in tune with these insane markets, and I teach these tricks to you guys out there, you traders out there. So please make sure you're paying attention. Remember, a lot of the things I teach you are geared for short-term trading, meaning you're getting in the morning, you're out before the close, trading sort of like that. But then there are other times where we step it out a little bit and we talk about a great deal of time and what should happen. In tonight's video being filmed on Wednesday night for Trading Thursday, that's September 22nd, 2011, we have right off the bat a red Omni on the board. Boo! We hate those red Omnis, right? Traders, it's a bright red Omni and it looks really ugly out there right now. Traders, as we know, futures trading is extremely risky, can cause you, me, and everybody around us substantial financial loss. We also know futures trading is certainly not suitable for everybody out there. If you do not have risk capital to lose, if you do not understand this game, if you do not place your stops first, please get up and run and turn this show off. But if you are a trader who does pay attention, who does understand the risks, and has some capital on his hands that he plays with, then get ready for what's coming next. Traders, in my last video, I showed you a couple of fantastic things, made a great deal of sense about what's going on in the world right now, and I would like to review some of that. So this show that you're watching now is largely going to review something that we've spoken about a little bit earlier this week, but is extremely important that you recognize it, get it in your heads, and get ready for it coming next week and the last couple of days this week. And what are we going to discuss? Traders, the indices, as we know, are in big bear flags on the daily and weekly bar charts, and I mean big bear flags. And bear flags generally produce bearish results. Therefore, we do expect these markets to break down at some point. But yes, we're in bear flags. Yes, bear flags are bearish in weeklies and dailies, especially when they're together, they're bearish. But how long can the bearishness last? You would think it's the end of the world coming. You look at the stock market today after the Fed came out and did nothing with rates, as we would have expected, of course. They didn't touch rates, and the markets crumbled. You will see why they crumbled in the chart segment in a couple of moments. It's got all to do with the bear flags, with the 200 bar moving average, with a big swing day right in the middle of it. It's got all to do with the technical analysis, and it is bearish. But how long can the bearishness last, traders? We have the dollar index going gangbusters towards the upside lately with a fantastic formation, bottoming formation that I've been showing you OMNI over the last few weeks in classes at the Academy, which is now beginning to actually happen. So bottoming formation in the dollar index makes the CRB index in the basket of commodities break down, and the price of crude oil is smashing. And like I told you earlier this week, that scenario of the dollar going up, crude oil and the CRB index going down, that simply equates to a huge worldwide stimulus package, traders. There's no better way to get money in the hands of traders around the world, of citizens around the world, of companies, of governments, of countries, of consumers. There's no faster way to get money in the hands of these people than through cheaper energy and cheaper raw materials and or cheaper commodities, creating cheaper product. Now, if you have a factory and that factory is suddenly paying less for its raw materials to create its product with, and it's paying less for gasoline and or petrol to get their product out to market, their margins increase, their profit margins increase. Traders know that and go out and buy their stocks. So what I am telling you is cheaper crude and cheaper CRB index and a rallying dollar in turn will be bullish for the world stock markets. It will not happen tomorrow. Tomorrow and Friday, we are steeped in bear flags, and we're going to complete that bear flag and go down. But then you got a couple of months before the year comes to an end, and that's when we should start to feel the effects of the CRB index going down, and certainly of the cheaper price of crude. That is what should start to happen. Traders, I am going to show you some fantastic charts in a couple of moments. If you like what you see in that chart segment, I want you to come down to my Omni camp. One of the last, if not the last Omni camps I'm ever going to hold is taking place this October. There are 2 seats left open. If anybody wants to study with me for 4 days in a private session, there's me, you, and 5 other people, and that's it. If you want to study with me for 4 days, come to one of my final, if not the final Omni camps, then come to my site, livewithoscar.com. Click the OmniCamp banner at the top and fill out the application. Traders, OmniCamp is in a few weeks in October. This is basically your last chance to let me know if you want to come. With no further ado, take a look at this. Okay, traders, we're going to start off with the leader of U.S. indices. And if you ask me, it's basically the world leader. And that is the Dow Jones Transportation Average. You'll recognize that this is absolutely, unequivocally a huge bear flag. We are well below the 200 bar moving average. Once we got below it, we had very fast down days, which will normally happen when you breach the 200 bar moving average. Traders, remember this. The 200 bar moving average is widely watched by fund managers, by traders, by hedgers, by professionals all over the planet. We all watch the 200 bar moving average. We all recognize that when you hold above it, it's a rally, and when you get below it, the likelihood is a big drop. Well, as soon as we got below it, we created the flagpole. Then we sat a few weeks and made this flag. Traders, the end result of a flag, a bearish flag, is almost always the downside. So that, the leader of U.S. indices, is absolutely looking bearish here. Let's look at the next chart behind it. It's the very same chart, traders, the Dow Jones Transportation Average, the DJTY, if you will. I zoomed in on the bear flag, traders. Look at it. We've hit the top, we hit the bottom, we hit the top, we hit the bottom, came down a little bit, could not get to the top this time. In fact, look at all the space between here and here that did not fill. You know what that tells me? We break down almost immediately. You couldn't go up high enough to give you another rotation. That means you're dropping out of the flag, not a rotation like this one, but this time you're dropping out of the flag and down you will go. That's what should happen. That's the Dow Jones Transportation Average on a daily bar chart, the leader of U.S. and world indices. NASDAQ, traders, look at this. Look at that chart for just a moment, and then I'll start to explain. Okay, what you are looking at here is a big bear flag, which we know is bearish in most cases. The 200 bar moving average, which we know keeps markets in check. When you are below, you stay below. When you get above, you seem to stay above. We rallied from the bottom of the flag to the top, down to the bottom, up to the top, down to the bottom, just about touched the top, put in a swing day up here. The next day being Wednesday, it broke down severely down to here, below the 200 bar moving average. This is on its way minimum to the bottom of the bear flag, and then most likely to complete the formation down below it. Another one of the industry leaders, the NASDAQ daily bar chart, extremely bearish, big bear flag, failed at the top in the form of a swing day, and breached the 200 bar moving average. That, my friends, is absolutely short-term bearish. Then we look at the E-mini S&P, well below the 200 bar moving average, absolutely in a bearish bear flag. And now it's basically below. This line represents major support from a few months back. It is now below that major support and staying below it. So this bear flag is absolutely working, just like the other bear flags I have shown you. The bear flags on the daily bar charts are short-term bearish signals unequivocally. Traders, let's keep going. Look at the FTSE. You can go around the world and see this in every world indice practically. The Hang Seng's getting slaughtered. The Nikkei doesn't look good right now. Look at the FTSE, the Financial Times Stock Exchange. This is the London stock market. Huge bear flag. End result should absolutely be the downside. Now this is on the daily bar charts. Short-term trading, of course, meaning the next couple of days this week and all of next week, this should be in effect. Traders, let's go now, move out a little bit. Let's zoom away from the dailies. Let's go look at some weekly bar charts. Once again, back to the leader, the Dow Jones Transportation Average weekly bar chart. It is now finally on the weekly. It just got below the weekly. It's down here right now. This bar goes down here below the weekly, or I should say the 200 bar moving average on the weekly. Below the 200 bar moving average on the weekly in the form of a big bear flag on a weekly chart. The leader, that, my friends, is bearish on the weekly, just like the daily. But let's delve in a little further. Wait until you see this chart right here. Traders, these are four markets all overlaid on one chart. You have the NASDAQ, the Dow Jones Industrial Average, the Dow Jones Transportation Average, and the E-mini S&P. Up here, first one is the NASDAQ on the weekly bar chart. Weeklies we are looking at, right? The weekly bar chart, unequivocally, big bear flag right here. Should be a breakdown. That's your NASDAQ. Right below it is the Dow Jones Industrial Average. Big bear flag on the weekly. Likelihood is lower. Below this is the Dow Jones Transportation Average. Big bear flag. Likelihood is lower. Then you have the good old E-mini ES, the E-mini S&P. Big old bear flag on the weekly. Traders, when you look at it in this fashion, the dailies, the weeklies, in bear flags, getting ready to complete the bear flag formations, this is about as ugly as the day is long. But I am here to say this. Yes, we're in bear flags. Yes, bear flags generally turn out to be bearish results, and we should finish or complete this formation and move down a little bit lower in each one of these charts. However, here's an argument, and I want you to take a close look at this next argument, because this is why I say the bearishness will not last. You are now looking at the dollar index daily bar chart. This very same chart was put before my OMNI at the Omni Trading Academy. For the past 4 or 5 weeks, we've been looking at this chart together. What had happened was we were in an extremely bearish market for quite some time in the dollar index, and it was making a series of lower highs, lower lows, lower highs again, and another lower low, then a lower high than the one before, breaks to another lower low, then a third lower low. And what happens next? It gets down to this low and stops, rallies, and puts in a high. So I said, okay, interesting, let's keep our eye on it. Comes down and puts in a higher low than the one back here. And I started to put this chart before everybody that I teach, all my students, and I said, look, this is very much turning into a bottoming pattern. Possibly we have a bottom. I'm going to wait for leg number 3. We have 1 and 2. If we get leg number 3, we call bottom in the US dollar. Now, what does that mean? If the US dollar finally bottoms, remember the teeter-totter, right? Here's your little teeter-totter. Dollars priced over here, commodities over here. If the teeter-totter goes this way, dollars down, commodities up. But if the dollar goes up, commodities go down. That's the only thing that can happen here, right? They're priced in dollars. They must go down if dollars go up. Here's the US dollar. We claim that this is a bottoming looking pattern. What happens? Turns out to be bottom, gets above the 200 bar moving average just recently and creates a huge bull flag, breaks out of the bull flag, and we're sitting right here, right now, as I do this class for you. Bull flag breakout above the 200 bar moving average, bottom formation looks complete. That means the dollar index is moving higher. What does that do for the rest of the world? Here it comes, traders. This is a beautiful picture coming next. That makes a basket of 17 commodities, including energies, including grains, including copper. You have meats in there, coffee, sugar, cocoa, platinum, natural gas. You got a lot of stuff in here, right? Some of the things we used to eat, some of the things we used to create product. That is the CRB index. Here is a basket of all these commodities in one basket, or as one chart. The CRB index. What you'll recognize is CRB index had a nice run up, then started to break into a bear flag, broke down further, tested the 200 bar moving average, rallied up, broke through it again, rallied up, broke through it, this time in a breakdown fashion. This looks like it's severe and will now begin to pick up speed. If these products are getting cheaper, that means the stocks that use these products to create product will go up. Traders, this is very important. This is what I want you to see. CRB index going down and the dollar going up means this will turn out to be a huge worldwide stimulus package. Let's look at the next chart. Okay, traders, crude oil daily bar chart, and here's where the scenario all comes together. Here's your crude oil, December daily bar. Huge bear flag, huge head and shoulders top, way below the 200 bar moving average, getting ready to go even lower. Remember that crude is priced in US dollars, teeter-totter. Crude is over here. Dollars are over there. If dollars go up, where does crude go? Down. Crude's not done going down yet if dollars are not done going up. Traders, this whole scenario amounts to a huge fiscal stimulus to the entire planet. Cheaper energy means cheaper gas for people who are going to work. It means they have a few more dollars in their pockets to buy some extra goods. It means factories pay less for their goods. That means they can either pass the savings on to the consumer, which I doubt will happen, or they could make more money in their stock profits because their margins for profit increase when their raw materials and or transportation gets cheaper. Traders, I want you to pull your own charts, do your own homework, take a look at the CRB, take a look at the dollar index, look at the crude oil, watch that scenario. Then when you look at the U.S. indices, you'll recognize that even if they are in bear flags, the likelihood is with these other markets moving lower, they will be buoyant to the stock markets of the world during the last quarter of 2011. So traders, there's the technical argument. That chart segment was so nice I had to do it twice. I started this chart segment in the middle of the week, revamped it, added more charts, and did it again for you in tonight's show. Because traders, let's face it, it's exactly what's going on right now. Yes, we're in bear flags on the weeklies and dailies, and that is bearish unequivocally. And we got a red Omni, and we are taking this bad boy down tomorrow, at least for the onset of trading. Look, anything could happen in a trading day, and it could turn around and end up $50 higher tomorrow. We all know that. So we use stops. We use protective stops. If we go short, we have a protective stop in place. If it doesn't work, we get knocked out of the market and we stop losing. Stops are extremely important. But we expect the market to go down tomorrow, at least for the first part of the day, probably all day, but at least for the first part of the day. Red Omni on the board. Why? Again, bear flags are bear flags. They do what they're supposed to do in most occasions, and that is knock a market down. That's short-term trading. You step this thing back out a little and think about a little bit longer-term trading. We all know when crude went to 145, it was the end of the stock market, basically. Then the stock market started to recover, and a couple of months ago, crude went to 115, and down we started to go again. Now crude's getting cheap enough to give us the opposite effect, the buoy effect. And I hope the crude goes down a bit lower. I hope the dollar goes a bit higher. I hope the CRB goes a bit lower. And that will buoy our stock market. So let's keep long-term planning for knowing that this is happening and knowing it does have a bullish effect at a certain point. Also knowing short-term that, yeah, we're short and we wouldn't want to be long with anybody else's money. So watch out what's going on out there. Be short for the short term, but then step back and think about the economics behind cheaper energy and cheaper commodities. Traders, I hope these videos are helping to keep you in tune with both the short and long-term picture. I hope these techniques are helping you learn how to view charts. Again, if you'd like to come hang out with me for 4 days in a real intense training session, you come on down to OMNI Camp and I will be more than happy to get you to really understand how to read those charts. All right, traders, make sure you keep your emotions out of trading. One of the best things you can do to help yourselves with that is say this to yourselves every morning, every afternoon, every evening, and you know what that is. Stops are in. Emotions are out. Yeah, 776. Futures trading is risky and can cause substantial financial loss. We do not claim or guarantee that you will profit from the information provided.